Imagine, like, knowing the exact hyper-specific diet of a winning racehorse, placing your bet based on that proprietary knowledge, and then just, well, waiting.
Sitting on it.
Right. 2 full months go by, and then suddenly the biggest institutional high roller at the track walks up to the window and drops a multi-million-dollar position on that exact same horse.
It's wild to think about.
It is. And we are looking at a case study today that maps perfectly to that dynamic. We're doing a deep dive into a retail investor who appears to be operating months ahead of multi-billion-dollar asset managers.
Which is, frankly, not how things usually work.
Exactly. And to do this, we are looking at 2 distinct pieces of source material. First, a series of posts from an independent market analyst outlining a highly granular thesis on the semiconductor supply chain.
Wait, very granular.
Yeah. And second, an official Rule 8.3 takeover code filing. I mean, this is a regulatory document that provides hard, undeniable proof of institutional capital flow trailing the retail thesis.
The timeline is really what exposes the market mechanics at play here. For decades, the accepted market structure has positioned retail investors strictly as, exit liquidity for institutional money.
Right, the dumb money, basically.
Exactly. The standard operating procedure dictates that hedge funds leverage their massive research budgets, alternative data streams, and expert networks to take early positions. Then retail buys the top after the narrative hits the mainstream financial press.
But this case study kind of flips that entirely.
It really does. It presents a structural inversion. It suggests the information moats protecting Wall Street are they're degrading.
Right.
We are seeing a real-time shift in who actually controls the absolute edge of supply chain discovery.
Okay, let's unpack this. Because the underlying thesis this retail investor posted isn't your standard macro-level market prediction.
Not at all.
They didn't just throw a dart at a tech ETF. The source text explicitly highlights their focus on, quote, latent NNP reactor capacity and identifying a specific lady supplier.
Which is a very specific bottleneck to target.
Very. They locked onto the stock ticker IQE based on this mechanical bottleneck. And precisely 2 months after they published this thesis and took their position, Point72.
Stephen A. Cohen's fund.
Yeah, that massive asset management firm. They aggressively accumulated shares of IQE at ATHs or all-time highs.
Understand the significance of that, we have to look at the material science they were actually tracking.
Yeah.
So NNP is indium phosphide.
Okay, indium phosphide, what exactly is that?
It's a critical semiconductor material utilized extensively in high-speed optics and photonics. I mean, it's the literal backbone of AI data center networking.
Oh, wow. So it's essential for the whole AI boom.
Completely essential. If you are building optical transceivers for data centers, you need indium phosphide. But you can't just, spin up NNP manufacturing overnight.
Why not?
Because it requires highly specialized MOCVD reactors. And the retail analysts realized that whoever possessed latent or unused reactor capacity for indium phosphide was sitting on a massive unpriced advantage.
So they were looking for whoever had the machines ready to go.
Exactly. They identified IQE as the supplier to LITI.
That's Lumentum, right?
Yes, Lumentum, which is a massive player in the optical networking space. The analyst essentially bypassed standard financial modeling and evaluated the physical choke points of the AI build-out.
They evaluated the physical choke points, published the thesis, and then 2 months later, this Rule 8.3 filing hits.
And that filing is definitive.
It really is. I mean, this isn't just a press release. It's a mandatory disclosure under the UK Takeover Code. It's only triggered when an entity crosses a 1% ownership threshold in a relevant security.
Right.
The document names Point72 Asset Management LP as the disclosure and IQE PLC as the offeree. It is definitive proof of an institutional whale deploying serious capital to secure a massive position. But I need to push back on the pricing dynamic here.
Okay, we'll hang up.
The source notes Point72 was accumulating at ATHs all-time highs. From a purely mechanistic standpoint, why is a highly sophisticated fund with infinite resources buying the absolute top?
It does seem counterintuitive.
Right. Why didn't Point72 identify the NMP reactor capacity bottleneck and build their position 2 months earlier when the equity was trading at a massive discount?
What's fascinating here is the liquidity constraints on a multi-billion-dollar fund. That fundamentally alters their execution strategy.
How so?
Well, an independent analyst managing their personal portfolio can spot an NMP capacity bottleneck, buy a few thousand shares, and experience zero market impact or slippage. They are essentially invisible.
Like a drop in the ocean.
Exactly. But a firm managing $30 billion cannot operate that way. If Point72 attempts to build a 1% stake in a relatively illiquid mid-cap supplier like IQE when the volume is low.
They'd just spike the price themselves.
Precisely. Their own buying pressure will skyrocket the bid-ask spread. They will trigger circuit breakers and basically destroy their own cost basis. They're forced to wait for liquidity events.
So they need the volume to increase just to physically enter the trade without moving the market against themselves.
They need massive volume. And that typically only arrives when the market at large finally wakes up to the fundamental value, which pushes the asset to an all-time high. It's a structural disadvantage.
So institutions trade agility for size.
Yes. The retail investor front-ran the institutional algorithms because they were hunting for raw capacity data, while the institutional capital had to sit on its hands waiting for sufficient liquidity to actually deploy their sizing models.
That's crazy. The amateur secured the bottom, and the multi-billion-dollar fund was structurally forced to buy the top.
Which isolates a very specific inefficiency in the market architecture.
But, you know, a single successful front run of Point72 could easily be dismissed as variance, like a fluke.
Sure, if you make enough esoteric supply chain predictions, eventually one aligns with an institutional 13F or Rule 8.3 filing.
Right, eventually you get lucky. However, the sources detail a repeatable methodology. This investor didn't stop at indium phosphide.
No, the author lays out a distinct pattern in supply chain mapping that moves well beyond a single lucky call.
Here's where it gets really interesting. The source text lists a rapid-fire sequence of highly obscure, completely validated supply chain connections.
Let's hear them.
First, they mapped out a company called NSG, identifying them as the TSM COUPE glass provider, just before Apollo Global Management literally took NSG private in a buyout.
Which is a huge catch.
Then second, they identified SIVE as a direct supplier to both MRVL and JBL. And finally, they explicitly mention utilizing a decentralized network. They noted they got help from a friend to uncover a company called Ribber.
Ah, Ribber.
Yeah, which they identified as the hidden quantum computing hardware supplier to Microsoft. I mean, how is a retail investor mapping these invisible pipelines better than giant institutions?
That specific list exposes the depth of the open source intelligence, or OSINT, that they are deploying. Take the first example. TSM refers to Taiwan Semiconductor's compact universal photonic engine.
Okay, that sounds intensely complicated.
It's cutting-edge silicon photonics integration. Uncovering that NSG was providing the highly specialized glass substrates for TSM's advanced packaging requires an incredible level of technical sleuthing.
Where do you even find that information?
They were likely tracking niche materials testing data or maybe specialized patent filings in foreign registries. And they did this before Apollo's quantitative models even flagged the acquisition target.
That is wild. And the same applies to identifying SIVE as the supplier to MRVL and JBL, right?
Exactly.
Because MRVL handles data infrastructure semiconductor solutions, and JBL is massive in manufacturing services. To find the tertiary supplier connecting them means the analyst is bypassing traditional quarterly earnings calls entirely.
Well, they are completely ignoring the traditional corporate narratives.
But the overarching question remains, like, how is this fundamentally happening? Wall Street firms spend hundreds of millions of dollars on alternative data.
They do. Satellite imagery, shipping manifests.
Yeah. They buy satellite imagery of parking lots. They scrape global shipping manifests in real time. They hire boutique expert network firms to interview former engineers.
It's a massive industry.
So how does an independent retail investor operating without a Bloomberg terminal or a multi-million-dollar data budget accurately map the quantum computing supply chain of Microsoft?
Well, the answer lies in that line you mentioned earlier, help from a friend. We are seeing the weaponization of crowdsourced intelligence.
Crowdsourced intelligence, meaning what exactly?
Historically, an institutional analyst sits in a silo. They might be brilliant, but they are generalists trying to cover an entire sector. What this author is utilizing is a decentralized network of actual specialists.
Okay, so it's not just random people on the internet.
No, a retail investor network isn't just a group of people guessing on a forum. It is often composed of actual materials. Scientists, patent lawyers, supply chain logistics managers, and engineers who work adjacent to these industries.
Wait, they're the exact people Wall Street pays $1,500 an hour to speak with on expert network calls.
They are the expert network, but they are collaborating directly with one another. If you want to find Microsoft's quantum computing supplier, you don't look at financial statements.
What do you look at?
You look at academic papers, published by Microsoft's Quantum Research Division. You analyze the methodology sections to see what specific molecular beam epitaxy equipment they're citing.
Oh, I see.
A physicist in the network flags the equipment. Then an engineer cross-references it to a French company called Ribber, and then a third person tracks the export licenses.
And they just piece it all together.
Exactly. By the time that data filters up to a boutique research firm and gets sold to an institutional desk, the retail network has already mapped the connection, established the thesis, and taken their positions.
Because they don't have to wait for committee approval.
Right. They are moving faster because they are unencumbered by institutional bureaucracy, and they possess superior domain expertise at the granular level.
So they are basically replacing a centralized, highly paid research desk with a distributed network of thousands of highly motivated, highly specialized human brains.
The compute power of that network is staggering.
It really is. But that brings us directly to the author's underlying motivations. I mean, if you actually possess this level of high signal asymmetric information...
You'd keep it to yourself, right?
Exactly. If your network has successfully mapped Microsoft's quantum hardware pipeline before the market prices it in, the rational profit-maximizing move is absolute silence.
Just buy and wait.
Right. You accumulate your position quietly and let the institutional capital eventually drive up the valuation. Yet this author is publishing the methodology and the discoveries in real time.
Well, the text provides a very explicit manifesto regarding their operational philosophy, and it directly challenges the traditional ethos of financial data hoarding.
Right. Let's look closely at that framing. The author writes, quote, "I happen to like democratizing information discovery synthesis to retail investors at the very beginning."
Democratizing discovery.
Yeah, and they go on. Instead of selling analysis to institutions or behind $20,000 plus paywalls. And they conclude their thought by asserting, stocks are genuinely positive sum where retail can get the lead for the first time.
It is a radical departure from the standard financial monetization model.
So what does this all mean? From a structural standpoint, I have to play the skeptic here.
Fair enough. Go ahead.
In capital markets, altruism is incredibly rare. And talking your book is the default state of existence.
It is.
If an investor builds a position in highly illiquid, obscure suppliers like IQE or SIVE, their immediate problem is a lack of volume, right?
Yes, they need buyers to step in.
So publishing a deeply researched, highly compelling supply chain thesis to a massive retail audience solves that liquidity problem instantly. It generates immediate buying pressure.
I see where you're going with this.
We have to consider the possibility that this quote-unquote democratization of discovery is simply a sophisticated mechanism to pump their own bags, to drive the underlying asset value up after they've secured their cost basis.
If we connect this to the bigger picture, analyzing market incentives requires strict objectivity. And the mechanics of talking your book are undeniable here.
Right, it's a known strategy.
If you identify an NNP reactor capacity choke point and take a position, the asset only appreciates if other market participants recognize the same choke point and deploy capital.
Exactly.
By open sourcing the thesis, the author rapidly accelerates the timeline of market awareness. It is a catalyst.
So they're speeding up their own payday.
Sure. Whether the motivation is altruistic democratization or calculated self-interest to drive momentum, the mechanical outcome is identical. The author profits from the subsequent retail and institutional volume.
The thesis basically acts as the marketing material for the underlying asset.
It does. However, acknowledging that self-interest doesn't invalidate the broader disruption occurring here. We really have to examine those $20,000 paywalls the author mentions.
The ones keeping retail out.
Yes. The entire institutional research model is built on artificial scarcity. Boutique firms map these exact supply chains and charge hedge funds exorbitant annual subscription fees for access to the data.
Right, making it so only the big guys can play.
But by taking institutional-grade OSINT, the COUPE glass suppliers, the MOCVD reactor bottlenecks, the quantum hardware pipelines, and publishing it publicly for free, the author is fundamentally destroying the commercial value of those paywalls.
Wow. Yeah.
Even if they are talking their book, they are transferring asymmetric information from the institutional sphere directly to the retail sphere.
And what about the assertion that the market is a positive sum game in this context? Because trading, at its core execution level, is often viewed as strictly zero sum, isn't it?
It is, but the author is drawing a distinction between short-term zero-sum trading and long-term capital formation in expanding technological frontiers.
Okay, break that down for me.
If you are day trading a highly liquid mega-cap tech stock, the alpha is heavily zero-sum. You're basically fighting high-frequency algorithms for basis points. Someone wins, someone loses.
Right.
But when you are mapping the foundational infrastructure of entirely new industries like AI data centers or quantum computing, the underlying companies are structurally growing. The pie is expanding.
So everyone involved early can win.
Exactly. The author's premise is that if retail investors utilize OSINT to collectively identify these infrastructural bottlenecks early, they can collectively deploy capital and ride the fundamental growth of the company alongside each other.
So they are front-running the institutional discovery phase, meaning retail captures the bulk of the multiple expansion before Point72 is forced to buy in at ATHs.
Precisely. They were establishing a paradigm where the decentralized retail network secures the early-stage risk and reward, while the multi-billion-dollar asset managers are relegated to the role of late-stage validators.
Which represents a massive structural inversion of traditional market hierarchies.
It really does.
It fundamentally reshapes how we view the flow of information in capital markets. I mean, we started today by analyzing a regulatory anomaly, a Rule 8.3 takeover code filing proving that a multi-billion-dollar titan like Point72 was trailing a retail thesis by 2 full months.
Which is still hard to believe.
Yeah. We broke down the underlying material science, exploring why latent indium phosphide reactor capacity is the actual choke point in optical networking, and why institutional liquidity constraints force funds to buy at all-time highs.
They just have to wait for the volume.
Exactly. From there, we mapped the decentralized intelligence network operating in the shadows, utilizing academic citations, export data, and granular engineering knowledge to connect obscure suppliers to giants like Taiwan Semiconductor and Microsoft.
The retail expert network.
Right. And finally, we dissected the philosophy behind open sourcing this intelligence, breaking down the $20,000 alternative data moats that have traditionally protected Wall Street's edge.
The sources basically map a clear transition from centralized institutional dominance to decentralized retail intelligence.
For you, the listener, the ultimate takeaway here is the sheer power of open source intelligence. The informational moats that Wall Street relies on are completely porous.
You really are.
The data required to front-run the smartest money in the room, the patent filings, the material science specs, the supply chain manifests, it's entirely public. It just requires the obsessive curiosity and collaborative network to stitch the raw data into actionable alpha.
Just putting the puzzle pieces together.
Exactly. The cheat codes to the market aren't hidden behind a Bloomberg terminal. They are sitting out in the open, waiting to be synthesized.
And that synthesis is the new baseline for asymmetric alpha. But it leaves us with a critical structural question regarding the future of institutional strategy.
Oh, what's that?
Well, we've established that retail networks are utilizing distributed human intelligence to map these incredibly obscure supply chain bottlenecks months before traditional research desks. But institutional capital adapts aggressively.
They don't just sit still.
Right. So the question you have to ask yourself is, how long will it be until Wall Street completely abandons the traditional analyst model and simply deploys sophisticated, large language AI models designed specifically to scrape GitHub, patent registries, and these exact retail networks,
Wow.
automatically co-opting their open source intelligence the millisecond it's published?
That is terrifying. If the decentralized network is the new research desk, the institutional algorithms will inevitably be trained to harvest it. That is a fascinating and, frankly, deeply complex frontier to watch unfold.